Welcome to the Deep Dive. We're your shortcut to getting quickly well-informed. Today, we're jumping into a part of financial reports that often gets skipped over. But honestly, it's packed with really critical insights. We're talking about the emphasis of matter and other matter paragraphs in audit reports. Our goal here is simple. Cut through the jargon, the accounting speak, and figure out what these notes really tell you about a company's story. Before we dive deeper, though, just a quick reminder, this deep dive is based on material from Farhat lectures. All the content, the examples, explanations, it's all derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe studying for the CPA exam, or already a professional, definitely check out the website. They've got additional practice questions, video lectures, and tons of support to help reinforce what we talk about today. And a special thanks to Professor Farhat for providing this valuable material. Okay, so you might look at an audit report, see these paragraphs, and just think, oh, footnotes, minor details, right? But I promise you, this is where it gets really interesting. This is where the auditor basically says, hey, pay attention. The specific thing matters. It's like a subtle nudge, but a really crucial one for understanding the real financial picture. So let's unpack this. What exactly are these EOM and OM paragraphs? Why do auditors even put them in?
Right. Okay, let's start with emphasis of matter. EOM. This is a specific paragraph an auditor adds when they want to draw your attention, the user's attention, to something that's already presented or disclosed somewhere else in the financial statements. The main statements are in the notes.
So it's not new information.
Exactly. It's already there. The EOM's purpose is really fundamental. It's to help you understand the financials better by highlighting something specific that exists within them. And it's important to note, this isn't the same as a key auditing matter or KMAM. Those are generally about the most significant things the auditor dealt with during the audit itself.
Okay.
EOMs are about emphasizing existing disclosures. And here's a key point. You only see an EOM when the auditor gives a clean opinion, an unmodified opinion.
A clean bill of health, essentially.
Pretty much. And this EOM paragraph, it shows up separately after the main opinion paragraph.
So it's like the auditor's waving a big yellow flag saying, look closer at this, but without saying anything's actually wrong with the report itself.
That's a great way to put it, yeah. Look here. This is important context.
Does that ever, cause issues? Like, could the market overreact even if the opinion is clean?
That's a sharp question. Potentially. The market can react to any kind of emphasis. But auditors use their professional judgment here. The idea is to only wave that flag when it's genuinely necessary for understanding, trying to minimize misinterpretation. Now, other matters, OM, that's different.
Okay, how so?
OM paragraphs talk about important things that are not presented or disclosed within the financial statements or their notes. These usually relate to the auditor's wider responsibilities, maybe things concerning laws and regulations or other details that give important context but aren't part of the company's financial reporting itself.
Got it. So EOM points inward to something in the financials. OM points outward to something outside them.
Precisely. That's the fundamental difference, the key takeaway for understanding what they mean.
Okay, let's zoom in on those EOMs then, the emphasis of matter ones. Our sources mention optional EOMs, times when the auditor uses their judgment call. What are some examples where they might choose to add one?
Yeah, this is where auditor discretion is key. A good example is related party transactions. So maybe Note 13 clearly discloses all the transactions with related companies. But what if, say, 60% of the company's total sales are to one related party?
Wow, okay. That concentration is huge.
Exactly. Even if it's perfectly disclosed according to the rules, that level of dependence is a significant risk factor. An EOM would make sure you, the reader, don't just skim past that. It highlights that dependency.
Makes sense. What else?
Another area is material events after the balance sheet date. Think about major stuff happening after the year ended but before the audit report is issued, like a huge fire destroying a factory, maybe a natural disaster hitting operations, or even securing significant new funding.
Right, things that will definitely impact the future.
Yes. And even if that info is tucked away in the notes, the auditor might decide its potential impact is so big it needs an EOM to make sure users really grasp the implications. Similarly, pending regulatory actions or major lawsuits, again, probably disclosed in the notes, but if the auditor thinks it's crucial for understanding the company's situation, they might emphasize it.
Okay.
And here's a really interesting one. Substantial doubt about getting concern, but where management has a plan.
So the company might be shaky, but they have a strategy to fix it.
Exactly. If there's serious doubt, the company can continue operating for the next year, but management has put together a credible plan to address the issues. and the auditor actually believes that plan is feasible and properly disclosed.
Then,
Then the auditor may choose to add an EOM paragraph pointing to that disclosure about the doubt in the plan. This is different from when there's doubt and no solid plan or the plan isn't good enough. That situation usually requires a more serious modification to the report itself, not just an EOM.
these examples really drive home how the auditor acts like a guide. They're not finding errors, but they are saying, hey, this detail, you need to consider this when you read these numbers. It's about focusing your attention.
Precisely. Highlighting what matters within the data that's already there.
Okay, so that's when they might add one. What about when they have to? When is an EOM required? No choice in the matter. This must be where things get really critical for consistency and transparency, right?
Absolutely. There are specific triggers where an EOM isn't optional. It's mandated. And usually it's because these situations directly impact how you compare the financial statements from one year to the next, or there's a fundamental change in how things are reported.
Like what?
Okay, first up, changes in accounting principle. Think if a company switches its inventory method, maybe from FIFO to LIFO, or changes how it recognizes revenue on long-term contracts, like going from completed contract to percentage of completion.
Because that changes the numbers directly,
Yeah.
period over period.
Exactly. It impacts consistency and comparability.
Mm.
So EOM required. Similar idea for an error correction involving an accounting principle. We're not talking about fixing a simple math mistake here. This is about correcting how an accounting rule was applied incorrectly in the past. Again, that impacts consistency, so it needs an EOM.
Got it. Comparability is key.
Definitely. Another one, a change in reporting entities. For instance, maybe a company now includes the results of subsidiaries it didn't consolidate before. The whole scope of what's being reported has changed. Needs an EOM to explain that shift.
Okay.
Now, this next one's really important. A justified departure from GAAP.
Wait, a company can just depart from the standard rules? And it's okay?
Sometimes, yes, if it's justified. GAAP is the standard, but in very rare specific circumstances, sticking rigidly to a rule might actually make the financials misleading. If the company departs from GAAP, and the auditor agrees that the departure is justified and still issues a clean, unqualified opinion.
Which seems counterintuitive.
It does. But if that happens, the auditor must explain this departure in an EOM paragraph. You, the user, absolutely need to know they deviated from the standard framework, even if the final opinion is clean.
That's fascinating. Why might they even do that? Depart from GAAP.
It's often argued it's to provide a more relevant picture for a very specific industry nuance or a unique transaction where GAAP doesn't quite fit perfectly. But yeah, it's rare and always needs that EOM flag.
Okay, what else requires an EOM?
If the financial statements weren't prepared using GAAP at all, they might be using a special purpose framework.
Cash basis or something.
Exactly. Maybe for certain nonprofits or governmental entities. If they're not using GAAP, the auditor has to emphasize what framework is being used so users aren't confused.
Right, context is everything.
And finally, a change in the audit opinion from the previous year. Let's say last year the auditor issued a modified opinion, maybe a qualified one, but this year it's clean, unmodified. That change needs to be explained in an EOM for clarity and comparability between the reports.
Okay, so looking at all these required EOMs, the theme seems to be total transparency and making sure you can actually compare apples to apples year over year.
That's it exactly. If something fundamental changes in the accounting, the reporting scope, the framework, or even the audit opinion itself, you need to be explicitly told. It's non-negotiable for the auditor.
So pulling this all together, what does this mean for you, our listener, trying to get smart about a company's finances quickly without getting lost in the weeds?
Well, the bottom line is EOMs highlight crucial info that's already inside the financial statements, sometimes optionally, sometimes because it's required. They draw your eye to important context within the numbers. OMs, the other matters, they point to important stuff outside the financials, like maybe auditor duties regarding laws. Both are there to give you a richer, fuller understanding than just the balance sheet or income statement alone. They add vital context.
So these paragraphs, emphasis of matter, other matters, they might seem small, but they're actually pretty powerful signals from the auditor. They can turn what looks like a straightforward, clean report into something much more nuanced, guiding you to what the auditor thought was significant enough to specifically point out. So here's your final thought for this deep dive. Knowing about these distinctions now, these flags the auditors can raise, how might that change the way you look at financial reports or company disclosures from now on? Does it make you maybe want to slow down and read those notes, those extra paragraphs, a bit more carefully? thinking about what the auditor really wanted you to see. Thanks for joining us on this deep dive into the finer points of audit reports. Until next time, keep that curiosity going.